Live from the internet, it's Tradestreaming Radio with your host, Tradestreaming.com's own Zach Miller.
Hey, this is Zach Miller at Tradestreaming Radio. You can find us at Tradestreaming.com. That's where we blog, and a lot of the information that goes into this podcast is housed. You can subscribe to this podcast on iTunes. Look for Tradestream. I'm Zach Miller. I'm your host. This is the week of November 29th. We've got a great show lined up today. We're talking a lot about research capabilities and how this may be impacted by the insider trading scandal that rocked the investment world this past week. Got a great interview lined up with the CEO and founder of AlphaClone, which is a great research platform that helps investors piggyback on top of the best picks of hedge funds internationally. And just a great show lined up. Hope you enjoy it, and check us out. Always, you can contact me at zach.miller@gmail.com. That's Zach, Z-A-C-K. Love to hear from you. Any future suggestions you have for the show. Let's get right into it. Unless you've been living in a cave, you've probably read something about a large insider trading inquiry that's been building over the past 3 years. Last week, the Wall Street Journal broke a story that numerous U.S. hedge funds had been raided by the FBI looking for evidence of large-scale insider trading. This is the largest inquiry of its kind and has blazoned across newspapers across the world. Beyond the merits of the case, and I don't want to focus on that, we may do that in a future podcast, I wanted to focus more on the fascination surrounding hedge funds. Why are people so interested in it? Why do people care what Warren Buffett says? Why do thousands of people flock to Omaha every year to listen to what an aging octogenarian has to say about stocks? I think people are really interested in hedge funds as they become the new celebrities. Many of them grace the pages of Forbes and are some of the richest people in America. Hedge funds themselves have become the new benchmark. There's a level of voyeurism here that investors are just completely in awe of these type of portfolio managers. How do they get to be so wealthy? How do these guys come to manage so much money? I think the answer, and this is what I wrote in the book, comes in two forms. One is that they do better research. These are well-oiled research machines, whether it's through technology or whether through employing really smart analysts. These guys are looking under every rock, every stone for the next investment opportunity. The second is that they're looking at companies that others aren't looking at. This is their edge. Many firms like SAC focus on small cap companies that no one's ever heard of. There's no research on these companies. They're spending the time and the energy and money it requires to do good research on these companies. And according to a paper by Joseph Stiglitz, and this was a paper he published in 1980, the paper's called On the Impossibility of Informationally Efficient Markets. Stiglitz writes, skilled investors are rewarded for the cost of information production, acquiring better information and or better processing of available information that keeps markets efficient. Such ability would enable the skilled investors, efficiency insurers, to identify mispriced stocks and earn positive risk-adjusted returns as compensation for information production. Right? So there's an opportunity here for people to exploit, and hedge funds are doing it. But more than that, we've actually seen a new strategy arise, and that's piggybacking investors. And I spend a whole chapter in my book talking about this. Part of the effort behind successful piggybacking of hedge fund investors comes from sort of discrediting the efficient market hypothesis. I grew up, I got my undergraduate degree from Harvard in economics, and rammed down our throats was this idea that mutual funds could never beat the indices over the long term. Some guys could do it in the short term, but that was part of a statistical pattern. But very few, in fact, almost none, could show sort of this persistence of returns. That changed in a paper that came out in 2005 called Imitation is the Sincerest Form of Flattery, Warren Buffett and Berkshire Hathaway, written by Martin and Puthan Parakal. And one quote there is, Warren Buffett's investment record suggests he is one of the most successful investors of all time. What they did was basically follow Berkshire Hathaway's portfolio performance, and they stripped out some of the non-equity positions so they could follow just the stock positions within Berkshire Hathaway as a holding company. And then they created what was called a mimicking portfolio. A mimicking portfolio basically would be constructed of following Berkshire Hathaway's monthly submissions to the SEC of their holdings and changes in their holdings. The portfolio then would buy or sell those changes in the portfolio. And what they found was that there was significant alpha derived just by mimicking Berkshire Hathaway's portfolio, above and beyond just having given your money to Buffett to manage on his own. That was a huge move, not only in moving towards sort of crediting hedge funds with sort of a skill level that we haven't been able to prove before, but also gave credence to this whole idea that, wow, by mirroring some of these guys' activities, you could actually build a back-tested, smart portfolio. And that is where AlphaClone comes in. AlphaClone is a research platform that at its backbone uses the regulatory filings of thousands of hedge funds and mutual funds around the U.S. and then creates a tool set on top to allow investors to devise and create back-tested investment strategies. For example, certain funds' performances can be replicated by just picking the most concentrated holding of those funds. There was research done to this effect by Cohen, Polk, and Silly called Best Ideas in 2009. They said, and I quote, "What if each mutual fund manager had to pick a few stocks, their best ideas? Could they outperform under these circumstances? We document strong evidence that they could, as the best ideas of active managers generate up to an order of magnitude more alpha than their portfolio as a whole, depending upon the performance benchmark. Other funds, though, can be better replicated by picking the top 2 or 3 holdings. Regardless of whether the fund can do that or not, AlphaClone provides a tool set to be able to test for that. It's not enough just to say, well, Stevie Cohen's buying this stock, I want to buy this stock. We're talking about a full-blown investment strategy, a replication strategy, and AlphaClone provides a really robust tool to do that. I actually am an AlphaClone user, and so I'm speaking from experience, just FYI. I had the opportunity to ask AlphaClone's founder and CEO, Maz Jadala, what the platform is all about. So Maz, there are numerous products out there that track hedge fund holdings. What's AlphaClone's premise?
Step 1, you should recognize that you're probably not going to beat the market. Step 2, having recognized that, you should probably give your money to the world's best minds to invest. And if you can't do that directly, AlphaClone is a great way to do it.